Well, we finish off the week with another red day. The S&P down 0.27%, nothing too extreme. The VIX is still at a pretty modest level, 17.5. Zooming out to give this better context, during an actual bear market, the VIX was at a level of around 30. So while the most recent 5% pullback is meaningful, a 5% discount, I'll take that any day of the week, we're still nowhere near a full-blown bear market. One of the macro events adding to the uncertainty in the markets is the potential of a government shutdown. So House GOP leaders failed to pass a short-term spending bill with fewer than 2 days left to fund the government and avoid a shutdown. And as of right now, the government is scheduled to shut down at 12:01 a.m. this Sunday. And this article here from CNN describes what exactly a government shutdown is. So there could be flight delays due to TSA workers, immigration, really the whole immigration process will just add to their backlog if they're shut down for a while. Programs like food safety, food assistance, transportation, infrastructure, national parks, all of these services will be on pause while the government is not being funded. Now, this is not the first time the government is potentially going to shut down. It seems like these events are becoming more and more frequent. Back in 1977, the government shut down 3 times in one calendar year for a total length of shutdown equaling 28 days. And more recently, in 2018, we had a government shutdown for a total of 36 days. So government shutdown certainly isn't good. It's adding volatility to the market. It's one of the reasons why the market has been going down recently, but it's something we've been through before and it's not that much of an unknown. Let me give you guys a quick update on my portfolio because we did cross a pretty major milestone of a total lifetime earned dividends of $4,000. And all of these dividends are being reinvested back into itself, helping this portfolio become a real compounding machine. So for example, SCHD recently paid a dividend of almost $90, and that went into buying XYLG, IXN, and Divo. The next day I was paid $36, and that went back into buying more QGRO. Alright, but the main thing I wanted to talk to you guys about today is actually 2 really interesting ETFs that I don't own. So when it comes to investing, we're all familiar with the 2 primary paths, growth investing and value investing. Value investing usually entails companies with a low PE ratio and high cash flows. They often pay a dividend, and funds like SCHD represent this category fairly well. The other mainstream category, growth, and this is defined by companies that have high revenue and earnings growth, so usually both top and bottom line. But there is a third category here, which is a little bit less known, and it's quality. And the main definition here is companies that are profitable with a high level of return on equity and return on assets. The best example here I can give you guys is ticker QVAL, and they define quality as having high return on equity, low debt to equity, and stable earnings growth. So a fairly simple methodology, and that results currently in these as the top 10 holdings. We have very recognizable names: NVIDIA, Visa, Meta, Microsoft, Apple, all of which I think we can agree are high quality, recognizable names. And here is the resulting performance. So this quality ETF has essentially the same performance as the S&P 500. And that puts quality as a group somewhere in between value and growth in terms of the long-term returns. But the 2 ETFs I want to highlight today take this quality metric to the next level by combining it with both growth and value companies. So the first name here is QGRO. This is quality growth companies. And then the other name here, the sister ETF, it's by the same company, is VALQ, quality value companies. And I gotta say, when it comes to the methodology, at least on paper, I am a huge fan of these. So both quality growth and quality value begin the same way. They start with the 1,000 largest companies, and they screen based off profitability, return on assets, return on equity, leverage, and momentum. That is the quality screen that is identical between these ETFs. And then the second part is where they differ between growth and value. So after that initial screen, they score the remaining securities based on valuation metrics such as earnings, cash flow yields, and dividend yield. And for quality growth, it's slightly different. Their secondary screen is sales, earnings, cash flow growth, and price to earnings and price to book ratios. That leaves each of these ETFs with about 200 names each, And for quality growth, these are the top 10 names. We do have some recognizable big names like Alphabet, Autodesk, Microsoft, as well as a mixture of other less popular companies. And the same thing largely holds true for quality value. And here is the side-by-side total returns over the past 5 years benchmarked against the S&P in this purple color. It appears that QGRO does nicely outperform the market over the long run, and quality value is more conservative. If we punch into the past 3 years when the market began to get more choppy, we can see that quality value did a better job maintaining its value and delivering lower amounts of volatility. So QGROW and QVAL are probably my two favorite ETFs that I don't own. Conceptually, when it comes to the methodology, I'm a huge fan. I think this is a fantastic ranking system, but I think where they fall short is they do not rank companies by market cap. And that's why when we take a look at the top 10 holdings, we have this kind of jumbled mess of random companies. And the data shows that large cap companies just tend to do better than small cap companies. I also think these funds are just a bit too diversified. As I mentioned, they have about 200 holdings each. So if I can make one change to these otherwise fantastic funds, it'll be to rank their holdings by market cap and to limit their holdings to just 100 names. And coming back to my portfolio, that is the exact reason why I chose this ETF instead. It has a very similar name, QGROW. This offering is from WisdomTree, and it's a pretty similar methodology. So the growth factor is determined by earnings, trailing 5-year EBITDA, and sales growth. And the quality criteria is 3-year average return on equity and return on assets. But where they differ is this is weighted by market cap. That's why if we take a look at the holdings here, we have the usual suspects up top: Apple, Amazon, Microsoft, Tesla. But you're going to notice that it is different than the S&P 500. We have Visa, MasterCard, United Health Group up top, Adobe, Netflix, Intuit, Blackstone, S&P Global, Starbucks, a combination of companies that are high growth, high quality, weighted by market cap, and it's limited to 100 holdings. So that's why I'm happy to hold QGROW by WisdomTree in my portfolio. But I still want to highlight these two sister ETFs. I think they are very unique, high quality choices, even though they're not exactly my cup of tea. Also, let me know in the comments, do you guys focus on quality while you invest, or are you simply a growth or value investor? I hope you guys enjoyed, and I'll see you guys in the next one.